hate buying insurance. And that's not some sort of polite British dislike. That's a visceral American hate. And we believe they should be able to, take their own risks themselves, that they should be empowered. So it's something that, I think we understand, and that's why we developed Repaid, which is, the mid-market alternative risk transfer plan. And, it's 2.0 form. It's new for 2021. And in essence, the plan's super simple. Step one, they get a quote for insurance. So it's the same completely conventional, ground up commercial P&C insurance coverage that they've always had. So we work with brokers. We respect the program that you've designed for your clients. And we try our very best to replicate that as exactly as possible. And at the same time, we're not really trying to seek betterment on price. We're not trying to, compete and drive the headline insurance price down. So what our job is to make sure that the loss ratios that are being delivered are a result of sound judgment and good risk management practice, and not just luck. We want them to be lucky too, but not just lucky. And at which point we've done a very granular underwriting exercise, and the client's in no real better position. So the products that we're underwriting, we're in the process of upgrading our capacity in terms of our flexibility, agility, and being able to deliver, really, commercial terms, at a speed that really benefits our brokers. And so the products we've launched so far this year are workers' comp, which has got statutory limits, and $1 million worth of employees' liability. That's with a niche specialty insurer called Simran, which comes with a Demotech A rating. Then on the GL side of things, we've got 2 million and 4 million in the aggregate limits. That's with Fortegra Specialty. So I are the first MGU to be granted delegating underwriting authority from Fortegra Specialty, which is Fortegra's new E&S insurance company. That carries an A- rating with AM Best. And we're also at the very start of developing an excess and umbrella product on the liability side with 5 million limits with Oxford, which is again rated A- with AM Best. We are partnering with Oxford really to make inroads into the commercial insurance market for them. And again, it's a very well matched capacity provision. Up until now, we've been focused on very large blue chip insurers, and we've been working with Liberty for the last 2 years. I think one of the reasons for restructuring in this way is a lot of large blue chip insurers, as I'm sure you have all experienced, can be quite bureaucratic. Their appetites can fluctuate, and that's the way big insurance companies work. And I think we are commercially much closer to these organisations as a result. We're hoping to launch our property facility for 4/1, and coming later in 2021, we've got a commercial auto to be launched. But all of that will have A rated and will either be E&S paper or admitted for workers' comp and auto. So all the benefit in the program comes in step 2, where we ask the clients to get a captive for reinsurance, and CICS will be forming those captives. And what we will do is offer the client a range of manageable, finite primary exposures. So what we do is we quote a range typically of 5 options, and and those options will limit the exposure. So we have any one occurrence limits of between $100,000 and $500,000. As you can see, the most typical limit the clients are choosing is $250,000. And there's always a 4 times aggregate stop loss limit. And that, so if they chose a 250, that would be $1 million aggregate limit. And that means the clients know at all times what their maximum possible exposure to an individual losses or an accumulation of losses are. The difference for 2021, as I touched on earlier, is that that's a finite exposure, but it's also now for a finite period. So there is an inbuilt option to completely novate any liabilities after 5 years. So that can be extended, but it's for all lines, including the workers' comp. And we didn't want to release the workers' comp product and leave the clients with captives with a tail that was tying up the resources in that captives and the collateral that they have to provide for not quite an indefinite period, but for a period that could be up to 40 years. So what that does is completely cut off that tail. And for this year, we've reduced the collateral requirement from 150% of the reinsurance premiums paid to the captive down to 125%. So it's making the product much more competitive. And so step 3, what we say is, get repaid. So the captive gets paid a reinsurance premium for the exposure that it takes. And that reinsurance premium can be for up to 50% of the gross written insurance premium. Now, there are a lot of factors that affect how much that premium will be. Obviously, the more exposure a client takes, the bigger the reinsurance premium. But also things like the bigger the propensity or the greater the propensity that specific risk has towards attritional claims, sort of frequency losses rather than severity losses, will tend to get them a bigger allocation in their captive of, reinsurance premium. And in forming a captive, there are a whole range of options. So they can, of course, reduce their total cost of risk, and look at the holistic price that they're paying for their insurance. Obviously, the underwriting profit is accumulated in a tax-free environment. Most of the clients don't take distributions. They tend to accumulate those resources over a long period of time. But a captive can be a tremendously flexible tool. They can use it for all sorts of things, whether that's like a retirement strategy or a succession plan, or they can use that money in all sorts of ways to give themselves competitive advantage. They could, for instance, buy machinery and equipment in the captive and lease that back to the operating business, in which case the lease costs are being paid into that tax-free environment. But they also get far, far greater influence over claims. So the client, they're basically now their own primary insurer, and so they get to interpret the intent behind policy coverage, which has the effect of reducing coverage disputes and making clients, generally speaking, far happier in terms of their experience of their own insurance. And on a day-to-day basis, as the claims are going through, the clients aren't on their own. They get full support from first notification loss through to final settlement of the claim from Gallagher Bassett and Wilson Elsa, who are TPO and program lawyers. We also work with another TPA on the workers' comp side called Brentwood. But the client's engagement in their own claims process is actively encouraged. So when they first come into the program, there's an onboarding call where they can say how much involvement they want and how much they want to be engaged. But that engagement is actively encouraged. And what we find is the act of empowering these clients to take those risks and manage their own claims makes all the loss ratios get significantly better. So although Repay has only been up and running since 2019, since the beginning of 2019, so for 2 or 4 years, all those loss ratios have all improved. Our current loss ratio, again, as I say, it's very green, but it's currently running at about, well, it's just over 2%, just over 2.5%. And that's just a factor of giving clients the ability to take their own risk and manage their own claims. So the program's been, very well received. Now that we've restructured it with new capacity and with new features, such as limiting the tail, we will of course be entering 2.0 with a new name for all these wards again, and hopefully we're going to win this time. But I mean, as a product, it's really designed exclusively for independent brokers. So we always use a broker. We're a broker only market. And really what we think is it helps you guys secure long-term revenue. So one of the things we tend to work initially with brokers or agents on one of their existing clients. And as we work through that process, they start to realize that this is a great way to maintain their income. So because there's no self-insured retention like there are or anything similar like there would be with other alternative risk transfer style deals, there's no reduction in gross written premium. The commission that's paid, we pay 10% commission, but it's paid on that same gross written premium. And really it becomes a tool to help brokers, well, succeed, but step one, to really increase client retention. So because captive ownership is a long-term strategic decision, Repay can increase the lifetime value of what's often your most valuable clients. So the ones paying big premiums, so therefore big commissions, and having few claims, so therefore low servicing costs. But almost all the brokers we've been working with, they start off with an existing client and then they realise that this can be a pretty much unbeatable tool to help with new business, or certainly to find a way to get that first meeting and kick the door open with a whole new conversation for the clients. And that means rather than having the big boys, your Marshes and your Aons coming swimming in your pool trying to take your biggest clients, instead you can go fishing in their pool for the first time. So we have this mantra: if you don't do this, your competitors will, and get repaid. So that's just about it from me in terms of overview and what's new. Rupert's going to take you through a case study, so you can see the underwriting process, everything that's required, and how all the numbers stack up, in an example risk. But if we could just pause there, I'm wondering whether anybody's got any questions that they'd like to ask at this stage. I'm aware I've covered a lot of ground. Is there anything anybody would like to ask?
Well, while we're waiting to switch over, and if anybody wants to ask some questions, just remember you got to unmute yourselves, or you can submit them through the chat feature. But while Rupert's starting up his presentation, I just want to kind of hit those highlights. So what Andy just covered, the program is now currently able to write workers' comp and GL, with the hope that property will come online here by 4/1 and auto a little bit later in the year. So that's a bit of a change for those of you who have been familiar with the program in the past, did not have the ability to write workers' comp. So I just wanted to highlight that for everyone.
Hey, Brian, I finally did make it in. It's Chris O'Donnell.
Hey, Chris.
I did have a question on the workers' comp in New York. New York is one of those few states that has unlimited employer's liability. Does your program contemplate that anomaly here within New York?
So we are initially underwriting, we'll circulate a list of the states which we're licensing in, I think it's 33 states right now. We're building out to all the states other than New York and California by the end of the year. It's going to take us a little longer to set up a facility for New York and California, just because they're sort of more difficult states to transact in. We're in the process of attempting to put a fronting solution in that will allow us to do the limits you're discussing, and a facility for specifically those two states, and any that we can't do in the interim.
Hi, Andy. Good to see you again.
Yeah,
it's been a while.
You're right, Chris. Yeah.
Reason I'm asking is you're working on two live accounts, one of which is mine, but both of which I'm familiar with a local broker here, and at least one of them, the property developer is all New York, and they're extremely interested in getting their comp into this program. They're insured right now, obviously. So I'm not sure that the broker is aware of the fact that your comp product is not going to contemplate New York State.
Yeah, like I said, a lot of that depends. Our ability to respond to New York depends on the renewal date. Yeah.
Yeah, it's April 1. Coming up.
Yeah, I think we're going to struggle for New York workers' comp on April 1st.
I guess you're on a big club struggling with New York workers' comp. But you've done
everything in New York's a struggle.
But you're doing New York GL, it looks like, though, right?
Yes, we are, although not for the contractors.
Right.
Rupert, do you want to come in here before I say yes to everything?
You're doing well there, Andy. Yeah, New York from the GL side is fine. There are certain trades that are difficult, the labour law in New York in particular, and that will feature on our appetite guide.
Very good, thanks.
Yeah, so if we don't have any other questions, Rupert, I think we can turn things over to you and let you get your screen share going, and we'll talk through kind of a case study on underwriting for everyone.
Yeah. Okay, can everyone see that?
Looks good, yep.
Come up on mine.
Okay, good afternoon, everybody. I'm the co-CEO with Andy and Chief Underwriting Officer for IRE, and we thought it'd be a good idea to take you through the underwriting process and how we integrate with you and Bryan and his team and Captive. I realise some of you are actually on dial-in, and we'll make sure that you get copies of these presentations, because obviously you're missing out on the visuals with that. And I'll try and describe it as we go through the presentation. So I've broken it down into a number of steps, and we'll follow these with each case that we look at, so it becomes a very familiar way of working for you guys. And obviously with captives, insureds that haven't previously been involved in it, or in fact if you and your colleagues haven't worked through on a conventional P&C program before, what we've tried to do here is make it as smooth and simple as possible. So step one, we start with the first step is to vet the client. IRE have an application form, and the first page is really just the core top line level information. And here I've used an example of a case that we actually insured. So we get a brief business description from you. We get the core information around revenues, payrolls, number of employees, what sector we're in. And then as we go down, what we're interested in is, who the current insurer is, what the current premium is, what the 5-year historic premium and loss ratio is. And you can see here that this client was running at 12.5%. So what I'm actually doing here is reviewing whether it's within appetite, whether the risk is running well, and that the premium and claims levels are suitable for the IRE program. As Andy was mentioning, this program is designed to reward those clients that are frustrated with the way the insurance market works. They want to get involved in sharing in the risk and the reward. They believe in themselves. It's not really designed for distressed business. It's not really designed for emerging markets. What I mean by that is things like cannabis or artificial intelligence or new things that are coming onto the market. Vapes, that was an emerging market a few years ago now. In terms of the premium size, it's really what works for the captive. And what we find with our models is that anything below 150k is really just not going to work for the risk and reward that the captive is taking. And similarly with the model, we need a 40% or better loss ratio. I think Andy mentioned the average is about 20%, and what we find is that each risk actually improves, not through anything we've done, but because they're now proactive and behaving like an insurer. In fact, it's their captive that is the primary layer insurer, albeit through a reinsurance mechanism. So the next step is that when we've got that, just that headline information, and as I say, the purpose of it is to avoid wasting a lot of time and effort in collating all the information that we would need to give you a full-blown underwriting quote. So what we try and do is assist you by creating a pre-underwriting illustration. And here's an example of that on the case that we were just looking at. You can see here that we list the gross written premium, what the premium would be for 5 years, the average loss ratio over that 5 years. This is just taken from that data that you'd given us, the initial headline figures. We then annualize the claims, and we look at the different limits that Andy mentioned within his presentation, the any one occurrence limit, and the aggregate is always 4 times. Now, this reinsurance sits on top of any deductible that the current insurance policy has in play. So that way we're comparing like for like. If you find you've got an insured with a great big self-insured retention and they don't want to put a big self-insured retention plus a captive retention on top of that, then what we'd work with you to get the insurance policy quoted up at a reasonable deductible for that for our program to mirror, to then for the captive reinsurance to sit on top of that. So as you can see here, I mean, when this isn't a huge premium, but it's quite good to look at one. I didn't want to take a great big case because some of you won't have premiums that are going to be a couple of $1 million. And this one is a good ballpark figure to work with. So in this scenario, with the insured just taking 100,000 any one occurrence, 400,000 in the ag, of the 357,500 that they were paying in the conventional market, we've matched that with our insurance policy, and now we get that insurer to reinsure back to the captive 93,000. So it's not a discount off of that premium, it's a repayment of that premium back to the captive. You can see the next line down is what the projected claims are against that premium income and what the annual captive underwriting profit might be. Now, obviously you can see there's some assumptions going on here, like the claims of the past will mirror in the future, but we're just taking a benchmark and we're using the client's own data as that benchmark. You can see as you go up the scale in terms of retention, how the captive reinsurance premium increases. I mean, this was actually not the lightest exposure, but you can see that they're still getting a fair percentage of their premium up here. Now, the way that this is modelled and worked out, the captive premiums, it depends on the industry. And what I mean by that is the propensity to have a large loss or the propensity to have losses within a captive retention, i.e. probably a bit more attrition. And in the event that you've got a client with more attrition, the captive's going to need more premium and therefore a bigger allocation or reinsurance charge to pick up the cost of those claims. Conversely, if you're not expecting the captive to have many losses, it's going to be a shock loss, then the capacity above the captive will need more premium. And we can walk through all of those as and when we get a live case and make it real for your insured. What we also do, Andy mentioned in his presentation about the build-up of underwriting profit or surplus within the captive, and the fact that not many people take dividends out of there. What I did was just using the single line of GL and the different options is multiply this up by 5 years so that you can start to see how one line of business actually builds up potential underwriting profit for the insured. Okay, so the purpose of that is to assist you in talking to your client and building a business case to investigate getting quotations for the captive or the repaid option. So the next step is the underwriting information, and this is contained within the application form. You saw page 1 earlier on, the headline information, and then we drill down in a little bit more detail per class with the different information that we require. Now we put risk management at the top. What we try and do is underwrite the insured. We look to understand why they have got a good loss ratio and capitalize on those reasons, because I think in the conventional market they often get frustrated that they do a lot of work around health and safety, around customer care, loss prevention, and they are just sort of bagged up with a trade code and rated the same as everybody else. And what this program does is reward it, that insured, with the underwriting profit coming back to the captive. So the more that you can tell us about the risk management, the better that we understand that insured. The more that an underwriter understands an insured, the more accurate their premium is going to be. And what we've done here is just build a checklist for you, and within that is the usual information that you would be providing the conventional market for your renewal, the accord forms and the loss runs, etc., etc. So that allows us to go away and do our modelling. Whilst we're doing that, what we like to do, steered by you, chaired by you as the broker or advisor, is to have a client onboarding presentation. And that would really be quite similar to what you've heard, but it allows you to chair it, bring us in and explain the program and allow for any questions, and really designed to assist you with the process of getting the client fully on board in understanding the repaid product. Similarly to that, and also whilst I'm still underwriting, there's a captive onboarding presentation. And that's where we bring, again, you're chaired by you, because you're the contact with the client, they're your clients. But this allows you to bring in Bryan and his team to talk about the roles and responsibilities that the client has in captive ownership. It's what's involved in setting up the captive, how it's managed, what they can expect, what is expected of them, how the financials work, and the responsibilities, really, getting them comfortable with that process. Then by that time, I should have finished the underwriting and offer you a quotation. And the way that this works is, again, using the same example that we've been discussing in here. It's for this contractor, and we produce, as you can see, a standard insurance quotation, and this has all the headline parts of coverage here. You can see limits, sub-limits, deductibles. This is the insurance policy. This has nothing to do with the captive reinsurance at this stage, other than this is only available providing that they have a captive and will reinsure back to that captive. And the reason that I just make that distinction is that the insured or the broker doesn't need to necessarily mention the captive reinsurance arrangements. If you were producing certificates of insurance, or you were advising somebody that the client has coverage, this is the A-rated policy coverage that they have, and this is the deductible that they insure with. What happens after that is that the carrier, in this case Fortegra, our new carrier, then buys the reinsurance from the captive. That's a separate arrangement and doesn't form part of that same discussion. But as you can see, going through the quote, we've got standard sort of policy terms and conditions that you would expect on any insurance quotation. Coming down to the subjectivities, as I mentioned, subject to entering into one of the reinsurance options, which is presented to the client at the same time. Within the reinsurance captive, there is a collateral requirement, and that collateral is in the form of a letter of credit and is designed to protect the carrier in the event of default of any reinsurance credit exposure to Fortegra. So here we can see the conventional premium that they paid last year, the option of terrorism, that works on exactly the same basis, where the client makes the election or not. And he mentioned that we pay commission on all of our business, 10%. Now we have a payment terms. This might be slightly different to what you're used to, 72-hour payment condition. And the reason for this is that the client's captive is on risk and therefore exposed to loss from day one. It's unlikely that they would have a payment request within 72 hours of inception, but nevertheless, we've got to get that money into the captive CICS's account or the captive's account in order to pick up any financial exposure that they may have, and also to know that it's safe, know that it's there. It's subject to US state surplus lines requirements, which we will sort out and get stamped and collected. Okay, then we move on to the reinsurance of the above. Now, this was effectively firming up the indications that we gave right at the beginning of the process, and this is what will actually be required. And the reason that we do 5 options is it really allows the captive manager, broker and client to review the income, the claims going out, the cost of the letter of credit, and make an informed decision as to which option is best. we are able to change the options year on year. And in fact, I've had a couple of insureds where they start at lower amount and they build up each year as they gain confidence, as they gain more surplus, because obviously the bigger the reinsurance, the more exposure you're giving your captive. And you can see here how this works in terms of the premiums coming through. And again, the illustration over the 5 years and how that builds up. Okay, and then finally, we let you close the deal with the client and look forward to the order. But if anyone has any questions about the underwriting process, then I'll be pleased to take them now. Okay, well, I think that's a good thing, Brian.
I was just going to say, if you do have questions, make sure you're unmuted because everybody is on mute now. But if we're not hearing any questions, then just know that, as Rupert mentioned a little while ago, we'll be following up with you all with these slides so you have them, as well as an appetite guide from International Re and the underwriting application that you'll need to complete on any of the accounts that you want to submit to them. As a matter of process, CIC Services works in coordination with International Re. Any accounts that you guys have that you'd like for us to review, we're happy to take a look at the outset. We'll share that information with International Re to get pre-approval, or you're welcome to send in your pre-approval submissions to International Re directly, just copying us either way. We want to make this as streamlined and as easy for everyone to operate under as we can. So feel free to reach out to me anytime. And once we get the underwriting info out, you'll have the contact info for the guys over at International Re as well, if you don't already. So having said that, if there aren't any other questions from the participants today, then we'll go ahead and wrap things up, give you back a little bit of your hour that we'd scheduled this on. And we appreciate your time today. Thanks everybody for joining us. Andy, Rupert, thank you for your time. We look
Thank you, Brian, and thank you to everyone.
Yeah, we look forward to hearing from you all. Thanks everybody.
Yeah.
Have a great day.
Take care.
Okay.
See you all.
Bye-bye.
Bye.